Most financial advisors will never tell you this because the truth would cost them credibility and commissions. They'll say, just buy term and invest the rest. But if that really worked, then why are so many people in America still broke at age 65? They'll call permanent insurance a scam. Cash value is trash value. Then turn around and sell you mutual funds that charge layered fees, management fees, fund fees, and trading, often totaling anywhere between 1.5% to 3% a year once you stack it all up. So let's be clear. The issue isn't term insurance or permanent insurance. The issue is ignorance. And ignorance has a price tag. How? Let's get started in 3, 2, 1. Let's go.
Hey, 7-figure squad. What we go? Run it up, run it up.
What's cracking, everybody? Money Smart Guy, Matt Zapala here. Welcome to the 7-Figure Squad YouTube channel. I'm a United States Marine Corps veteran, a faith-made millionaire, and a field leader of one of the fastest growing financial insurance marketing organizations in America. And so far this year alone, my national agency has helped over 22,830 plus families protect their future with life insurance. We've written well over $28 million in life insurance premium, and we launched over 1,830 new licensed agents into their careers, and we're only 9.5 months into the year. Bottom line, we've seen it all. From the peanut gallery, to the nasty relatives, to the financial advisors whose advice usually starts and ends with stocks, bonds, mutual funds, and ETFs to buy. And I can say I've seen it all because I've been it all. I've held my Series 6, my Series 63, Series 26 license. Currently today, I have my life and health license, but I choose not to renew my securities license, not because I left finance, but because I wanted to create free speech. And for many of you know, once you have those licenses, there is no free speech in terms of compliance on social media. So I wanted to create an educated marketplace, even if people never did business with me. And for people that want to do business with me, they see how I do business. So our agency doesn't buy leads. We don't cold call. 99% of our business comes from word of mouth. We don't advertise. We don't cold call. We don't go door knock. We do none of that. We see our clients weekly because they partner with us either part-time or through strategic alliances. That means we just don't preach financial education. We actually practice financial community. So today, let's separate the myths from the math, the religion from the reality, and the sales pitch from stewardship. If you've noticed here, I got a stack of books here from my library that I personally read myself. And by the way, just so you guys know, the best book out of this whole entire stack is the Bible. There's so much text in here about how to manage money from a financial stewardship standpoint. Over 2,600 verses about money. In a Bible verse, over 39% of Jesus' ministry was about the stories about handling money and possessions. Because when you want to understand money, you want to get consumed with information like I have, you want to understand taxes, you want to understand protection strategies, you want things to finally work together. When they do, you stop being a customer and you start thinking like a CEO. So let me break it down. Term insurance versus permanent insurance. Let's discuss term insurance, which is what? Temporary protection. Term equals temporary. Temporary for 10 years, 20 years, 30 years, which means the lowest amount of cost, yet no cash value inside these policies. However, if you die during your term, your family's protected. Sadly, if you outlive it, it's over. It's like renting. Cheap when you're young, but brutal when you renew. 98% of term insurance policies never pay a death claim. Now, that's not because they're bad. It's because people outlive them or just cancel them too early. Term is a starting line, not a finish line. It's great leverage, but zero longevity. The sad part about term insurance is, let's say, for example, you bought it at 30 years old. Next thing you know, you're 60. And how fast does life go by? Blink. Next thing you know, honey, I think I still need my life insurance policy. We've refinanced our house a couple of times. We bought new property. And this term insurance policy is expiring at 60. Now I'm 61. Now I have to pay a much higher premium for the life insurance policy I currently have based on annual renewal term rates, which explodes in cost. I said before, cheap when you're young, super expensive when you're older, especially if you have an annual renewable term type of situation. Now, let me break down permanent life insurance. Permanent insurance, which includes whole life, universal life, index universal life. Now, these things, they build cash value. It lasts your entire life, and it gives you control. It gives you access, your own cash for emergencies, for investments into business or equipment, or for your retirement. All these are often done without triggering income taxes under Internal Revenue Code 7702. See, permanent insurance isn't about dying rich. It's about living smart. Protection, liquidity, plus legacy, ownership. And when structured right, You're not buying insurance. You're building your family bank. Now, here's where term insurance actually makes sense. So let's be real. Term isn't the villain. In the right season of life, it's actually your best weapon. I still have a lot of term insurance. These scenarios, for example, if you're a young family, you have a tight budget, you need maximum death benefit coverage per your dollar, term is an excellent way for you to build leverage while you build your cash flow. But again, inside the policy, there's no cash value. Oh, second scenario here is income replacement. Let's say you have a $100,000 a year salary. You want to replace your income by 15 years. So you need to have $1.5 million of income to replace. Now, term insurance covers that, and that math is around 60 to 90 bucks a month at the age of 30. So seriously, very affordable and expensive. It's like so cheap that these insurance companies are daring you to buy life insurance. What about if you're in debt or you have a business loan, like a mortgage or an SBA loan? Term perfectly matches the loan length so your family or your business partner isn't stuck with debt. What about a scenario with college-age kids? Well, use term until they're independent. They're past 18 or 20 years old. So this buys time while you, as a parent, still grow your assets. Here's one of my favorite. What about a conversion strategy? Start with term, end with perm. But we start with term. There's a conversion option that lets you switch to a permanent policy later on without new medical underwriting. In other words, you buy it young, you lock in your health. Even if your health were to change down the road, you lock in your healthy, inexpensive life insurance premiums. And that's how pros buy time and build future leverage. So let me walk you through how to assess how much life insurance you actually need. It's called my DIME analysis, D-I-M-E. So let's do the math together. So let's look at my screen here. And we have a nice little worksheet here for you. And by the way, if I'm making sense to you right now, this whole term versus permanent, if the premise is right, please put makes sense in the comment section below. Makes sense. Awesome. Okay. So this is a worksheet. If you like, we can send this worksheet to you to your email. We'll put a link in here of how to get this worksheet absolutely for free. To my promise, we want an educated marketplace. If you look at this screen here, this term versus permanent decision guide, DIME stands for, it's an acronym, hello military training. DIME stands for D for debt, I for income, M for mortgage balance, E for education. So let's say, for example, you've got $50,000 in credit card debt and car loans. Let's say you got $150,000 a year job and you need 10 times to 15 times your annual income. In this case, let's just put 1.5 million. That's 10 times your annual salary. So 10 times your annual salary, 150,000 times 10 is 1.5 million. What happens if you have a $500,000 mortgage balance, life insurance to pay off that mortgage? What about education? Let's say if we have a child, you have a couple kids, it's $200,000 total for two kids, $100,000 each. So if you add this up, right, you've got your, let's say $1.5 million. You got your $500,000 for your debt, or excuse me, for your mortgage, $200,000 for your education, $50,000 for debt. So let's add all that up. So here you got 5 plus 5 plus 5 is 10, plus 2 is 12. So you need $2.2 million of life insurance. That's what you need. So the question for you now is step 2 is figuring out what your situation is. And for most people, when they're younger with kids, they have a tight budget and you need to maximize your coverage right now. You need to get a lot of term insurance. You see, I told you I love term, but it isn't the only strategy out there. And I'll explain here throughout the length of this video why permanent insurance potentially might make sense for you. So in this scenario here, your protection strategy, there's so many different scenarios that we listed out that may be your scenario and why a blend or individual policies of term or permanent insurance may be appropriate and suitable for your situation, but you got to make that educated decision for yourself. I provide some guidelines here so to help you understand your scenario. If you go here to the other side of the worksheet here, use a quick self-check on which profile are you? Are you somebody that needs protection first? Are you somebody that needs to build and protect? Are you somebody that needs cash flow and control? Or do you need somebody who wants to leave an inheritance for your children? See, term insurance isn't for everybody. I think any advisor or any insurance agent that says everybody needs to do this and everybody needs to do that, I think that's false guidance. I think everybody's scenario, it depends. It depends on how much you care about your family, how much you care about your nonprofit organization you want to leave some money to. It cares if you want to take care of your kids or some kids, real talk. Maybe you have some kids that have an addiction and you don't want to give them a splash of cash and inheritance or life insurance money to continue that addiction. So there might be some different scenarios why certain people want to buy term or permanent. It's not a one all be all. It's a depends. It depends on you. So even in this self-checkout, which profile, there's a combination of term you need to consider purchasing, maybe a term blend with a permanent life policy, maybe a maximum funded index universal life policy, or even here a permanent or a trust setup. Again, it depends on your situation. So, for example, if you want to know what type of percentage of your salary you should be tucking away for monthly protection, it's anywhere between 3 to 10% of your income. Why? Does it make sense for you to take 3, 4, 5, 7, 10% of your income to protect the other 97 to 90% of your net worth? That's why people buy life insurance, is to minimize risk, or in some cases, eliminate risk altogether to prevent your family from being exposed to what goes on with life. In this scenario here, you need what, $2.25 million? Let's say, for example, you get a $1.5 million of coverage and $750,000 of permanent coverage. It might equal between $300 to $480 of your salary. If you do the math, let's say, for example, $150,000. Let's say $150,000, you have anywhere based on this budget, 3 to 10% of your income, anywhere between $4,500 to $15,000 should go to some form of future savings, protection plan, savings plan, etc. And it can be, again, a combination of term insurance and permanent insurance. But this is the budget you should set aside from your salary or your income from your business to have a protection plan. Again, some more, some less, but this is a general guideline of what you should put away. So therefore, you have some form of logical way to appropriately handle your finances. So therefore, it isn't all going to one area or one segment. So let's destroy the number one myth in personal finance, which is what? Buy term and invest the rest. Now, sounds cute, sounds responsible, but there's one problem. People don't do it. Most people who buy term never invest the rest. Why? Their budget is tight and life just gets in the way. Their emotions also beat their discipline and they withdraw early or they panic when the market drops. So what happens? They buy term, but they never invest the rest. The policy expires and their family ends up with nothing. And the philosophy of being self-insured never happens. So let me say it again so it sinks in. Term without discipline is financial gambling. Term without investing, the difference is renting protection. Term without a strategy fails most families 98% of the time. So let's continue tackling the next myth, that cash value insurance, too expensive, huh? No, it's not. It's that nobody ever showed you the math. Let me discuss to you a little bit of velocity and friction. Now, before we dive into this fee comparison board, you're going to notice a few things. Every row starts around $1.2 million. See, that's on purpose. I'm playing the level playing field game. And here's a scenario. In these different strategies I'll share here in a second, they all have the same $1,000 a month strategy. They're saving that every month for 30 years, and they have the same 7% growth rate. Now, yes, this is a gross number. The reality in real life is that fees, taxes, exposure to the stock market will actually slow your velocity long before you reach that total. See, this chart isn't about who grows their money the fastest. It's about who keeps their money lasting longer. Think of it like a race where every car has the same engine. One drags a trailer of taxes. One drives uphill with 1.5% in fees every year. One's got the emergency brake of limited access. And one, the IUL, the permanent life policy, it's on its own private road. No tax tolls, no penalties, and protection built in. Same horsepower, different friction. That's why they don't all finish the race at the same distance. So here's what happens. When you save $1,000 a month for 30 years, same growth, different friction. The do-it-yourself index fund, my S&P 500 no-load fund, right? They have low fees. They got low fees, great discipline if you stay the course for these 30 years, but you still owe taxes every year. You keep around $1.1 million, but your family's unprotected if life hits early. So let's take a look at this. Again, here's the gross money. Not to say that everybody's going to end up, but I'm just saying, again, this is illustrating to say, again, same engine, but the difference is what? I'm just trying to illustrate one thing. The drag of taxes and fees, and I'm not even talking about the exposure to stock market losses. Because at the end of this fee drag of $6,000 in fees, it sounds little, right? But the tax drag, the exposure to whatever you gain, you have to pay taxes on. So your net amount is a little over $1.1 million. Now you have access to money, but there's no protection. There's no life insurance attached to this strategy. You have to have that term insurance on the side, which is a completely different component of this DIY, do-it-yourself, S&P 500 index fund. Now, the second one, which is an advisor-managed account, same return assumed, but 1 to 1.25% in fees bleeds out $140,000. And as you see, it's still taxed, still no protection all the way to the right. Same thing, just a little bit more fees, but now at least you have some advisor you can call throughout the last 30 years to lean on in case something happens in the market, you feel uncomfortable. Now, let's look at the other strategy, 401k or an IRA, individual retirement account. Now, this looks good on paper until you subtract taxes in retirement. Now that 1.2 million becomes about $772,000 of spendable cash in retirement. And guess what? Along the way, you're locked out of this access before you're 59 and a half years old. Let me just share that all these three strategies, the do-it-yourself index fund, the advisor managed account, or the 401k account, they don't address the number one cost that everybody experiences in retirement. And the number of reasons why people file bankruptcy is what? Changes in health. And healthcare costs go through the roof. Many reports state that in retirement, in addition to what you have saved for income, you need another $400,000 just to set you aside for healthcare. I can't tell you how many times we've seen clients not only spend down their savings, but accelerate that spend down because they need somebody to help them at a nursing home or home healthcare. We had a client in the East Coast, very well-to-do area. Politician, if I shared the name, you know who they are. Before he passed away, the last 18 months, he was spending $8,000 to $12,000 a month on home healthcare because his wife couldn't lift him up. His wife couldn't help him to the bathroom. His wife couldn't help him bathe. His wife couldn't help him feed. They had to hire round-the-clock healthcare providers to make sure his quality of life was as best as it could be as he neared the end of his life. So once again, none of these plans have any protection included, and you have to accelerate the spend down of those savings when the worst case scenario happens in your retirement years. Oh, by the way, did I mention these plans also have no life insurance because that whole buy term and invest the difference philosophy? Well, it's done in your 60s. It's done in your 70s. There's no permanence to that insurance. And if you want life insurance, it's based on annual renewable term cost, which accelerates in cost the older you get. So if you want more life insurance as you get older, it actually gets more expensive based on a buy term and invest the difference philosophy. What about the last one? It's called maximum funding your index universal life policy, or maximum funding your whole life policy, or maximum funding your universal life policy. Yes, there are internal costs to this. To a maximum funded index universal life policy, there are costs based on this in compliance with 7702. What is this internal cost? Cost of insurance, cost of protection. But here's the thing. There's no tax drag. There's no penalty age requirement for you to access your money before 59.5-year-old rule. And there's built-in protection and living benefits. In other words, if something were to happen to you, you survive a heart attack, stroke, cancer, complication with diabetes. You need somebody to take care of you, home health care. You go to a nursing community, you need money for you to stay at that retirement community. Your money stays working while you are borrowing and loaning your money. And since you funded this policy with after-tax money that's already been taxed in your checking account, and you fund it into the policy, there is no longer any tax on it as it grows in accordance with 7702. In other words, your money can grow without paying a dime in tax, and then later on down the road, you can access this money without paying a dime in tax. At any time before age 59 and a half years old or 65 or 70 years old, you won't be paying any income tax on the money you were accessed when you pull this money out. Well, some of you guys are saying, oh, Matt, this internal cost is index universal life policies. Don't you have to loan your own money? Well, here's the reality with index universal life policy. Your money stays working in the upside of the stock market and upside of S&P 500, whatever index you choose, while you access it. It's not like you're withdrawing it and cashing it out like a 401k or a stock bond or mutual fund. Most people will pay more in fees and taxes to Wall Street over 30 years than they ever would in a properly structured index universal life policy. And this is what I discovered with this book, Ed Slott, The New Retirement Savings Time Bomb. He talks about losses, he talks about taxes, and he talks about healthcare. And we interviewed him and discussed the situation at our events because he's figured out, he's known as America's IRA expert.
Most people don't realize they have a partner, Uncle Sam. And I don't know if you know it, he's not even your real uncle.
So the issue isn't that cash value is too expensive. It's that nobody shows anyone the fee drag, the tax drag, the ups and downs of the stock market drag, and protection gap side by side. And when somebody calls it a ripoff, I just say, show me your fee disclosure. Show me your 30-year discipline. Show me your tax plan. Show me your protection if life goes wrong. And many, they can't. Because most people, they don't have a strategy. They got slogans. And respectfully, but truthfully, to the Dave Ramsey disciples out there, Dave Ramsey helps people get out of debt. Respect for that. But if he were right about building wealth, banks wouldn't use cash value. Investors wouldn't use cash value policies. Wealthy families wouldn't use cash value. And guess what? They do. Dave Ramsey, he teaches a lot about financial survival. And I'm talking about financial leadership and generational impact. So let me share with you a strategy inside an index universal life. Some people say, well, you got these cost, fees, expenses. Well, here's the thing. The strategy here is avoiding losses altogether. Because here's the thing. Back to 2005. See, this is our strategy. Our strategy got what? Time tested stress test. We're going back all the way to 2005. Based on the growth of the S&P 500, every year, the growth of the S&P 500, 3%, 13%, 3.53%, negative 38.49%, 2008, 2009, to 23.45%, all the way to 2024. You see the growth in the market, and also you see the losses. Let me highlight the losses right quick. Here's the losses. Imagine putting your money away, your serious money away for supplementing your retirement plan. Now, I want to disclose to you as well. Most people look at life insurance as an investment. And from a legal perspective, life insurance is not an investment. Don't confuse the two. This is a great strategy for you to grow your money with the life insurance industry to create certainty and predictability, knowing that in case the market crashes, you got to know in that these years of 2008, 2015, 2018, 2022, remember the 2022 during the pandemic, all the stock market was just screaming and real estate was screaming. Next thing in 2022, bam, crash. Well, none of our clients have ever experienced any losses inside index universal life policies or index annuities based on the safety and guarantees contractually inside these policies. Now imagine having a plan for your retirement. Now you probably got your 401k plan, you probably got your real estate, you probably got your own brokerage account. Great. Those are all great. You should have money there. But this is a great financial foundation, a great financial cement to make sure that if the market were to crash, money inside these policies aren't exposed to those losses. As you see here, in the negative years, what's the policy credited? Policy is credited with 0. In other words, your cash didn't lose money. The other year here, 2015, what was credited to the policy? 0. In 2018, negative 6.24% was credited to the policy. 0. Here in 2022 was credited to the policy. Nothing was credited nor taken away from the policy in these examples I just shared with you. This is safety. This is clarity. This is I can retire in peace. Because most people, they have their money, they have a hope strategy. Let me just warn you, hope is not a strategy. And in my book, Gotcha, I talk about one of the gotchas of money. The first gotcha of money is avoiding losses. When you experience a loss in the stock market, you need a much more positive return just to recoup what you lost. For example, here, 38.49%. You actually need a 61 to 62% return just to recoup what you lost here. Did the client have that experience come back in 23.49% the next year? No. Did the client cumulatively experience that with 12.7% next year? No. They're still under what they lost in 2008. So in other words, 2 years has gone by. Actually, 3 years has gone by. And they still are trying to get back what they had previously in 2007. So you lose also your greatest asset, which is time. So the strategy about buy term invest the difference is being able to stomach the losses in the stock market over the next 30 years. Tell me a perfect condition where that happens. For example, if you're ready to retire in 2008 or you're ready to retire in 2022, you got $1 million in your retirement account, you're ready to retire. Next year, you experience a negative 19.44% that year. Your $1 million account reduces down to another $190,000, $200,000 lost in that year. Your $1 million becomes an $800,000. What are you going to do? You're going to unretire and go back to work. Because if you lost 19% in 2022, to get back what you lost, to get back you to square one, you need actually 23 to 24% rate of return the following year just to get you what you lost. Thank God that happened. But imagine if it didn't return 23 to 24% the following year. You're holding in a panic mode. You're figuring out what to do at that point. Do you unretire, go back to work, or do you write it out? But still, Matt, term is cheaper. Again, sure, until it expires and you're 60, 65 years old with health issues. Cheaper today can mean costlier tomorrow. Well, Matt, I'm just going to invest the difference. I'm going to self-insure. Well, here's the reality. 70% of people never invest the difference. You can't compound what you never contribute. Well, Matt, based on your IUL, I'm going to get better returns in the market. Sure, maybe. If you can stomach the losses, you can stomach the taxes versus the index universal life policy letting you ride out the index without experiencing any crashes or any losses. We say, Matt, clients don't need that much insurance. Sure, spoken by someone who's never delivered a death claim check like I have. You know what I've never experienced? A wife saying, man, this is too much insurance. Never before in my life. Well, Matt, permanent insurance, whole life, universal life, index universal life, it's just too complicated. Hello, that's called education, not deception. Complex means you just need a better teacher. Well, Matt, I heard that in whole life policies and permanent policies, when you die, the company keeps your cash, huh? How about that? Well, that's actually half true. From the 1980s, old whole life policy had one death benefit option. Your family got the face amount of the policy, and the company kept the cash. But when E.F. Hutton came around, he introduced universal life policies in 1982. Guess what? Everything changed. You now have option A, level death benefit, and option B, an increasing death benefit, meaning your heirs got the face amount plus the cash value that's inside the policy. So no, the company doesn't keep your cash. That's old school thinking in a modern IUL world. That's like selling pagers in a smartphone world. Well, yeah, Matt. Well, why am I loaning my own money? Well, actually, you're not. You're collateralizing your own capital, that's cash inside your policy, with the insurance company giving you access to their money using your cash value as collateral. So in other words, your cash continues compounding inside the index even while you're using it, unlike a stock, bond, or mutual fund. It's not a loan from your money. It's a loan against your money. You're leveraging your asset without having to liquidate it. And that's what banks, that's what real estate investors, and that's what CEOs do every day. Hello, welcome to the big leagues. And let me just show you some data here. These are banks ranked by life insurance assets. This is the part of the big league conversation. The top 15 banks here. Northern Trust Company, very familiar. They were in Chicago, right down on Cermak and 22nd Road, right by our office in Oak Brook. $2.3 billion in life insurance assets, all the way to number one, Bank of America, with over $25 billion of life insurance assets. So if it wasn't a serious class, it wasn't a serious asset, why would these banks then own cash value life insurance assets? And by the way, it goes back, the data goes back to 1992. So this is just a one-time thing, a two-time thing, a 5-year thing, a thing that you saw on TikTok. This is a strategy that's been around for a minute. Now, let me go back to the whiteboard here, back to the strategy, the fee comparison. Remember this scenario here? It was somebody saving $1,000 a month, okay? And some people say, well, Matt, how come you're not putting the money inside a Roth IRA? How come you're not putting that money inside a Roth IRA? Hello? The most amount of money you can put inside a Roth IRA in 2025, and you're under 50 years old, is $7,000. So this $12,000 here cannot go inside a Roth IRA. In addition to that, how many guys plan on becoming wealthy? Now, if you're single, the phase-out limit of your salary, meaning there's an income limit that once you hit it, you can't put money inside a Roth IRA. It's a no-go at $150,000. And $165,000 modified adjustable gross income, completely eliminated if you're making over $165,000. So if you're out there, you're making $200,000 a year, or you're a business owner, you pay yourself over $200,000, guess what? No-go with the Roth IRA. And if you want to put $1,000 to the Roth IRA, you couldn't do it anyway because the maximum contribution to a Roth IRA is $7,000 a year. If you're over 50 years old, it's $8,000. So the only strategy that allows you to put money where it's avoiding losses, minimize and eliminating taxes altogether, from a tax advantage standpoint, and has benefits attached, not only living benefits, but also death benefit, is a maximum funded Roth IRA. It's the only game in town. It's the only financial strategy. And I'm sorry that not other strategies out there like this that the life insurance provides. I wish there was another strategy out there. Crypto don't do this. Real estate doesn't do this. Bank accounts in itself don't do this. Brokerage accounts by itself don't do this. Welcome to the life insurance industry, and actually getting yourself educated about the life insurance industry has to offer. If you're married, the limit for single people was $150,000. But if you're married, the limit, the phase out is $236K. If you have an income and you have $236,000 a year of married filing jointly, you can't contribute money inside a Roth IRA. Again, that sounds like a lot of money you can put inside a Roth IRA, right? But you can't put $1,000 inside a Roth IRA. Most amount of money you can put inside a Roth IRA is $7,000. So there's a limitation here with a buy term and invest a different philosophy if you're using a Roth IRA to invest a difference. But let me show you something else that a lot of people don't even see. Let's say you, again, use the max funded index universal life strategy, a permanent life strategy, not a term strategy. Guess what you get immediately? If you pay $12,000 annually, your premium annually into a life insurance policy, what happens? You pay one premium of $1,000 for that first month. And Lord forbid something happens to you. Well, right away, in this case, a 35-year-old male, standard non-tobacco, gets $798,000 to his beneficiary, to his wife, to his kids, to his living trust. Right away, he puts $1,000, Lord forbid, if he dies tomorrow, $798,000 goes to his family. What happens if you put $1,000 into your S&P 500 no-load index fund, $1,000 into your advisor managed account, $1,000 into your 401k or IRA? What happens? You get $1,000 minus the fees to your beneficiary. Guess what you don't get in these three different strategies? You don't get this. You don't get the $798,000. Hello, life insurance. This plan self-completes your retirement plan, self-completes to pay off the mortgage, self-completes send your kids to college, self-completes being debt-free. in one premium payment if, Lord forbid, you die tomorrow without paying a dime in tax according to Section 101A of the IRS code. No money received by death, benefit, or proceeds are exposed to income taxes. But some of you guys are curious. I see, wondering what type of books I have. If this stuff is making sense to you, I'll actually share the stack of books with you. If you put in the comment section, books, put books in the comment section. If you're curious what books has allowed me to obtain this, not only knowledge, but also experience working with clients, I'll give you my book list, this stack list here, if you comment the word books in the comment section below. Let's get back to this chart. Now, I just explained a death benefit. What happens if you become ill? What happens if you suffer from a heart attack, stroke, cancer, and you survive? Well, you get up to $20,000 per month to recover, or you get a $931,000 lump sum from a critical benefit if you need to use it right now, if you want to. So this money that you have here, as this money grows and accelerates, you have a critical illness, you have a $931,000 lump sum cash, income tax-free to be used your way. Lord forbid, you come across Alzheimer's, dementia. There's a $1 million lump sum here you can access from this policy without paying a dime in tax while your policy values here grow by the time you're age 70. A Roth IRA wouldn't do that. A brokerage account wouldn't do that. A IRA or 401k wouldn't do that. But an index universal life policy, life insurance retirement plan will do that. Here's the reality. Not all, but most advisors, they teach what's easy to sell. Same thing on the life insurance side of things. Not what's hard to understand. You can't invest the rest if life keeps taking it first. And renting protection like term insurance is fine until your lease runs out and your family is the collateral. And by the way, just so you guys know, for those of you believers out there, faith isn't ignoring wisdom. It's applying it before the storm hits. If you really want to build generational wealth, legacy isn't what you leave your kids. It's what you leave in them. That's your legacy. My friend and client, Dustin Frampton, young father, husband, graphic designer, and the guy who actually built my website, moneysmartguy.com. After watching my videos, he was building my website and reading our website copy. He calls me one day, he calls our office one day and says, Matt, I need to get a policy. So I said, why? So he tells me, Matt, I'm from Trinidad, Tobago. My wife's from the south side of Chicago. And we got 4 kids and we homeschool them. And people work with me in my business. I can't afford to leave them exposed to something were to happen to me. So he comes to the office and we help him get a policy, about $70, $80 a month with living benefits attached. Sadly, 18 months later, we get a call that shook us. Dustin was suffering from a stroke at just 38 years old. But because his policy was in force, the life insurance company issued a multiple 6-figure check, free and clear, no taxes, for him to use however he needed. He didn't have to ask for permission. He didn't have to beg for GoFundMe help. He had protection that actually showed up when life went sideways, and it often does. He told me, Matt, this policy didn't just save my life. It saved my family. And no, that's not a slogan. That's what modern life insurance contracts do. That's what protection that lives when you do. As I wrap up, let me just share with you one of my favorite scriptures. It says in Proverbs chapter 13, verse 22, a good man leaves an inheritance to his children's children. And understand this with scripture. That's not a suggestion. That's actually a standard. True wealth isn't just cash. It's wisdom. It's stewardship. It's freedom from financial bondage. So please, I encourage you, stop renting everything. In addition to owning your faith, own your future, own your protection, own your cash flow. And if this hits home and you're ready to protect your family and build your own system based on your circumstance and situation, come and protect in the comment section below. My team and I will send you this free resource, this 2-page worksheet to help you compare term and permanent for your situation. Because when you understand protection, you gain peace. And peace is priceless. If you got value from this episode, please consider subscribing if you haven't done so already. And please drop your biggest takeaway in the comment section below. That being said, from Dallas, Texas, I'm your Money Smart Guy. And until we meet again, continue to live smart, continue to love smart, and be money smart today.